Thanks for joining and watching this brief investment video. I'm Ross Bramwell, a member of Hammack Berg's investment department. In today's video, we're going to discuss a little bit how, because the job market remains so strong, it's been one of the biggest challenges for the Fed in order to reach its 2% inflation goal. Inflation has remained sticky and has even reaccelerated in certain parts of the economy, especially within a few service sectors. However, unemployment may not be the critical element or even the Fed's focus at this time. Declining wage growth and whether it continues to decline may be the key element needed by the Fed in order to initiate its first cut later this year. We continue to see very solid jobs data each month and a sign that the U.S. economy has been very resilient in the face of the Fed's rate hiking cycle. Fed Chairman Jerome Powell even acknowledged in his most recent press conference that the Fed would not have to wait to see an uptick in unemployment rate or softness in the job market to initiate its first rate cut, which was a reversal of prior comments. That was an acknowledgement that the jobs market has remained resilient and that the Fed has had a negligible impact on the jobs market. April's job increases of 175,000, which was lower than expected, shown here in the top right chart, but it's still an extremely healthy number for a growing economy. Continuing claims in the bottom right-hand chart has been very steady over the last year. However, as the Fed is still waiting to see supporting data that inflation is on a sustainable path to its 2% target, the Fed is still taking cues from the job market. The tight job market is one aspect that has made the Fed's goal very challenging over the last year. After the pandemic, a supply-constrained job market sent wages higher, shown here in the tan line. You see the steep increase right after the pandemic, and unemployment to over 14%, and then back down to a 50-year low of around 3.5%, the burgundy line. Unemployment is off the lows, but it has found a tight range still below 4%, as unemployment claims have yet to pick up meaningfully and job openings remain elevated, as we saw in the prior charts. However, the historical trend is that the unemployment rate tends to look like a playground slide. Unemployment does not pick up gradually, but shoots up quickly, as typically when a recession occurs, companies are forced to lay off workers. Unemployment then declines gradually as companies pick up new workers as the economy recovers. Therefore, we believe it's unlikely that we will see a meaningful increase in unemployment until we have a recession. But when we do have a recession, it tends to take a leap. On the chart, we also show wage growth, which is in particular focus right now because of its pass-through effects on overall inflation. Wage growth was very strong in the early stages of the economic recovery back in 2000, 2001, even 2022, especially in areas such as hospitality or areas where it was struggle to find workers such as healthcare. But these conditions have slowly abated as market tightness has eased and the bargaining power of workers has declined. Overall, we think that the labor market will continue to normalize, which means maintaining a low unemployment rate, and that we will continue to see a deceleration in the wage growth. Both factors should be a welcomed combination for the Fed as it looks to cut rates over the next year. Services inflation has become the overwhelming problem area for the Fed, as pandemic-led goods inflation has reversed and consumers are largely seeing stable or lower prices in many consumer goods areas. You can see this in the chart with the gray area, the core goods. You can see that the contribution to inflation has been declining steadily over the last couple of years. You can also see that for food and energy. But for services, it remains the largest contributor to inflation that we're seeing today. And the largest input to services inflation is wages. The Fed's initial plan was that the rate hiking cycle would slow the jobs market and bring inflation back down to its 2% target. However, the robust jobs market may likely keep the Fed from cutting rates this summer and cause it to extend the higher for longer rate environment. However, if wage growth continues to decline over the next few months, that may offer an opportunity for the Fed to cut, as it should help services inflation also come down over time. Chairman Powell was insistent that the Fed's next move is still a cut, and it appears that the bar is much lower for cutting rates and that rate hikes are not on the table. Declining wage growth, if it continues, will help the Fed achieve their goal. Thanks again for joining us and watching this video. If you have any further questions, please reach out to a member of your client service team.